Welcome to our comprehensive training module on structured FX products. This module is designed for finance teams in medium-sized businesses and corporations, and anyone interested in understanding the complex world of foreign exchange derivatives. In this module, we delve into the intricate mechanisms of structured FX products, their applications, underlying principles, and the various types available in the market. We will explore the building blocks of these products, including forwards, options, and more exotic structures, and how they can be combined to meet specific financial needs. Our goal is to equip you with the knowledge and skills necessary to understand the benefits and risks and manage structured FX products effectively. Whether you're looking to hedge currency risks or improve returns on your deposits, this tutorial will provide valuable insights into these complex financial instruments. Structured FX products are complex financial instruments typically used by financial institutions and businesses with foreign exchange needs. These products are considered complex derivatives, financial contracts that are based on underlying currency exchange rates. They can be tailored to meet specific hedging or investment needs of businesses or investors. Unlike standard FX products, such as spot trades or simple forwards, structured FX products combine various elements, such as options, simpler derivatives, and other financial instruments. Such combinations result in products that can be customized to offer specific payoff structures, catering to different risk appetites and market views. Structured products are often used by well-advanced finance teams that have the expertise and tools required to manage the financial risks that come with these products. The primary applications of structured FX products include reducing hedging costs. By using structured products, companies can potentially reduce the costs associated with currency conversion and FX management, especially when compared to using standard FX products, but only if certain conditions are met or market events occur. The cost reduction is mirrored by higher costs in scenarios when specific conditions or events don't materialize, leading to higher risks. Structured products can also enhance investment returns. They can be designed to enhance potential returns on currency investments, although this often comes with increased risk. Structured FX products are versatile tools, offering a range of solutions for risk management and investment. However, due to their complexity and the risks involved, they require a thorough understanding and careful management. The majority of structured FX products are based on the concept of monetizing the uncertainty of future FX rates. When anyone has views about future FX outcomes, option markets allow the construction of payoffs that would turn such views into financial contracts, and the present value of these potential payoffs can be calculated and locked in by trades in financial markets. Let's have a look at the exchange rate of the euro against the US dollar in the example. Protection against the depreciation of US dollar can be costly, as financial market prices, FX forwards, imply steady depreciation. However, FX markets also expect future exchange rates to remain uncertain. The market for FX options is where one can buy or sell protection against this uncertainty, and as a result, it can help one calculate the price of such uncertainty for most currency pairs and future periods. The graph here demonstrates the option implied uncertainty in the form of a 95% confidence interval. This is the range where the market expects the future euro-US dollar FX rate to be with 95% confidence in statistical terms. Imagine you firmly believe that the euro-US dollar exchange rate won't rise above 120 in the next 12 months. Another participant in the financial markets could pay you $10 or $20 to purchase a contract, where you would need to pay them nothing if the exchange rate does not exceed 120, but pay them $100, in what you think is an unlikely scenario if it does. You can combine this contract with a regular forward, where you would achieve a lower effective FX rate if your market view proves correct. Structured FX products help businesses that don't have access to wholesale option markets or skills to construct complex FX strategies to achieve the same results. A bank or another provider can sell you a package, a structured FX product at a price and conditions that their trading desk calculates. The trading desk can then replicate such a payoff using basic FX options. By entering into a structured transaction with a client and hedging using simpler FX derivatives, the bank will cover its own risks to currency fluctuations in all scenarios while locking in a small profit. This concept is at play in the majority of structured products. Most products offered by banks combine a Lego-like concept of building blocks to produce the desired profile to fit clients' appetites towards acceptable risks in exchange for more favorable costs or enhanced yields. But the underlying principle remains the same, a trade-off between improved economics, if one's view is correct, and an additional cost in one shape or another if it is wrong. The three most common types of structured FX products include option-based structures, including combinations of vanilla, digital, and exotic options such as barrier options. Forward-based structures, such as participating forwards, which combine elements of both forwards and options. Combination structures. These involve complex combinations of various derivatives, like dual currency investments and target redemption forwards, also known as TARFs. These products can also come with features like knock-in and knock-out options, where the product becomes active or inactive if the underlying currency hits certain price levels. The building blocks of structured FX products include a variety of standard financial instruments, each with its own set of characteristics and applications. These are the main building blocks. Forward FX contracts, agreements to buy or sell a certain amount of currency at a predetermined rate on a specific future date. These are used to hedge against the risk of unfavorable currency movements. Plain vanilla FX options. The most basic type of options, with a straightforward payoff, giving the holder the right, but not the obligation, to buy, in the case of a call option, or sell, in the case of a put option, a currency at a predetermined price on a specified date. Digital options. Options that have a fixed payoff if the exchange rate is above, in the case of a call, or below, in the case of a put, a certain rate level on a specified date. Knock-in and knock-out barriers. Contracts where a payoff becomes active or inactive if the underlying currency crosses a certain barrier. Path-dependent structures. Options where the payoff depends on the path taken by the currency rate, not just its final value. Examples include accumulators, TARFs, or look-back structures. By understanding these building blocks and how they can be combined, finance professionals can better comprehend the structure and potential applications of various structured FX products. This knowledge is crucial for effectively utilizing these products in finance, whether for hedging, speculation, or investment purposes. Below are some examples of structured products. The list is not exhaustive. It covers the most popular products and is meant to demonstrate key features of selected products. A participating forward is structured as an FX forward contract with a built-in option. A corporate buyer usually purchases an embedded option, with its cost, option premium, being built into the contractual forward rate and thus not requiring any upfront payments. It has a basic structure. The forward contract portion provides a hedge against adverse currency movements by locking in an exchange rate for a future date. The options portion allows participation in favorable currency movements to a certain extent. The hedging amount, the portion of the exposure that is protected, and the participation level, the portion of the exposure that can benefit from favorable movements, are predefined. For example, a 50% participating forward allows the company to hedge 100% of the currency exposure while being able to benefit from 50% of any favorable currency movement. The downside is limited irrespective of the participation level as the client is long an option. If the currency moves favorably before or at maturity, the company benefits from the appreciation on the portion defined by the participation level. If the currency moves unfavorably, the company is protected by the forward contract portion and only participates in the downside to the extent of the participation level. A dual currency deposit, DCD, is a financial product that enhances the yield on a deposit by monetizing the premium of a currency option that the depositor sells to the bank. This structured product involves two different currencies, hence the name. Its main benefit is an enhanced yield on your deposit. So how does a DCD work? To start, an investor deposits funds in one currency, the base currency, the deposit has an agreed-upon maturity date and an interest rate, which is usually higher than standard deposits. Linked to the deposit is a currency option, where the investor agrees that the deposit amount may be repaid in a different currency, the alternate currency, at a preset exchange rate. On the maturity date, if the exchange rate is favorable, based on predefined conditions, the investor receives their initial deposit plus interest in the base currency. If not, they receive the principal and interest in the alternate currency at the preset rate. FX accumulators and decumulators allow the buyer to purchase or seller to sell a foreign currency at a rate, which is called a strike price, that is typically more favorable than the current market rate. In exchange for an exchange rate that is more favorable at inception, the client commits to transact a predetermined amount per observation, thus selling the optionality to the bank. There are numerous variations of an accumulator combining one or two side ranges, notional multipliers, as well as knockout conditions. These products can be used in a scenario where a company expects to make or receive regular payments or receipts in a foreign currency. Its benefit is lower FX hedging costs if your market view is correct. An accumulator contract is set up where the buyer commits to buying a fixed amount of a currency at a predetermined strike price over a set period with a set frequency, provided contractual conditions are met. During the accumulation period, the FX spot rate is observed on predetermined dates, such as weekly or monthly. If the spot rate is within a predefined range, the buyer is obligated to buy a predetermined amount of the currency at the strike rate. Many accumulators come with a knockout level. If the currency pair's rate moves unfavorably past this level, the contract is terminated. TARFs, target redemption forwards, are designed to offer improved FX rates compared to standard forwards, but with certain conditions and potential risks. Because of the payoff asymmetry that the target redemption feature creates, TARFs are akin to selling an option, albeit with a more path-dependent and complex profile. The value of the optionality sold is used to produce the improved FX rates mentioned above. How does a TARF work? A TARF is a series of forward contracts where the investor agrees to buy or sell a currency at a predefined rate on multiple future dates. The defining feature of a TARF is its target redemption condition. This condition sets a profit target for the series of trades. Once the cumulative profit from the trades reaches this target, the TARF terminates automatically, regardless of whether all the scheduled trades have occurred. On each predetermined date, for example monthly, the spot rate of the currency pair is compared to the strike rate of the TARF. Depending on the contract's terms and the currency movement, a trade may or may not occur. Some TARFs include a knockout level. If the exchange rate moves beyond this level, the TARF is cancelled to prevent further losses. Knock-in and knock-out structures can be used to reduce the costs of hedging by adding additional conditions that activate, knock in, or deactivate, knockout specific features or the entire contract based on predefined currency levels. As with other option-based forward contracts, the contracted rate is usually improved relative to prevailing market rates, but can be lost, knocked out, or replaced with a contract with inferior conditions. Hence, their benefit is lower FX hedging costs if your market view is correct. Knock-in forward contracts have features that become active only if the exchange rate hits a pre-specified level, the knock-in level. If the currency never reaches this level, the feature or the entire contract is not activated. This type is often used when an investor believes that a currency will only need to be hedged if it reaches a certain level of volatility or weakness. Knockout forward contracts are active from the start, but become void if the exchange rate hits a certain level, the knockout level. They are used when there's a belief that the currency will remain stable and only needs hedging against deviations within a certain range. Next section covers some good and bad cases of corporates using structured FX products. Safran is one of France's largest companies, with an average annual exposure estimated at $9 billion. With revenues in foreign currencies, dominated by the US dollar, Safran hedges their long-term sales for maturities up to 4 years. Due to basic FX forwards to purchase euros being too costly, Safran often faces high costs of hedging using vanilla instruments. For example, when the euro-US dollar spot exchange rate was at 1.13 in 2018, forward contracts could only lock in much worse rate of 1.25 for a 3-year maturity. Safran mitigates these risks using a structured product program. In 2018, structured options helped achieve a target exchange rate of USD 1.12 or below with limited risk. Safran's structured FX program is managed by an experienced team and communicated to the internal and external stakeholders. A strict hedging policy is regularly reviewed and approved by the board of directors and the audit committee. Market information is regularly updated, mark-to-market impacts, and expected USD net exposure and hedge rate targets on a 4-year horizon. The second example highlights the risks of structured products. A UK-based garment importer and an FX broker fought in court following post-Brexit volatility in pound-sterling exchange rates, which resulted in £3 million of losses, the company claimed, halving its operating profit for 2017 and leading to the demise of the subsidiary that had entered into the contracts. The company said it wanted simply to hedge against fluctuations in the dollar-to-sterling exchange rate when it engaged the broker, but that the broker recommended it should enter increasingly complex transactions that resulted in it taking risky speculative bets. Shortly after, the FX broker exited the FX options business, citing a change in its strategy. An article by Reuters said at the time, "Lawyers say they are working on similar claims worth hundreds of millions of pounds in total, against large banks and leading currency brokers accused of breaching their duty of care to their customers." The examples are designed to highlight the fact that structured products are not suitable for all companies, particularly small or inexperienced finance teams. If your company uses or plans to use structured products, the following actions can help avoid surprise disappointments and stressful situations. Establish a hedging policy and procedures. Set up internal controls and governance structures to avoid outsized risks and losses. Establish regular oversight and reporting to ensure that the board and/or directors are aware of the hedging decisions and outstanding risks. Request scenario analysis from your financial service providers for large structured FX transactions. Ensure that contracts are managed by the team that understands cost-benefit analysis of using structured products. As we conclude this training module on structured FX products, you should now have a thorough understanding of these complex financial instruments. From their basic principles to their varied applications, we hope you've learned how structured FX products can be useful tools for financial risk management if used with skill and diligence. Remember, while these products offer tailored solutions, they also carry inherent risks and require a sophisticated understanding of financial markets. It's crucial to approach them with caution and informed decision-making. We encourage you to apply this knowledge responsibly and continue exploring this dynamic field for more advanced strategies and insights. Your journey through the world of structured FX products doesn't end here. Keep learning, stay curious, and ensure your financial decisions are well-informed and strategically sound. Thank you for listening to this tutorial.